Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome back. This is the Investor Coaching Show. Paul Winkler talking money and investing. Covering the news of the day and the news of the week in the financial world and explaining it in terms I think you can hopefully understand. I think you can get this stuff. I think it's critical that you get this stuff because if you don't get it, you're having to blindly trust the investing industry. Now we know, and I've talked about this on TV this week, talked about how people make most of their decisions, the vast majority of their decisions about investing from an emotional standpoint. One psychologist basically says 100%. And you go, how could that be? How could people be making so many decisions based on just emotions? Well, they have instinct to go toward pleasure, go away from pain. You have emotion. I feel good about this. I'm scared of this. Fear will come in there. Greed will come in there. You'll have trust. I just like this person. I don't know what it is. You have this concept called transference. In other words, somebody reminds you of somebody that you liked from your youth and you just trust them. And you're like, well, I don't know why I trust this person. I don't know why I like them. And it just because it's somebody that you remember that you liked when you were a kid, maybe even. It's just weird how our brain works. And loyalty, I think that their commercials are so good. I think those squirrels are so cute. I just have to invest all my money with that investing firm. Even though they're paper mache squirrels, they're fake squirrels, I think I still need to do that. So just stuff like that. And, the investment firms know this is what's going on, so they cater to it. And it's unfortunate, but that's just the way it works. So I'm going to do my best to work on the cognitive side, that part of your mind that is analytical and just takes a little bit of time to understand what am I doing, why am I doing it, how does it work, okay? There's an article about the stock market. Now, volatility, when I talk about risk, if I say the word risk to you, what does it conjure up in your mind? Probably, if you're normal, it conjures up the risk that I could lose my money. Now, that is not what academics are referring to when they talk about risk. Risk to them, you've got to be able to measure it, number one. Well, I can't measure, is something I can't control something I can't measure. And when you think about, how do I measure risk in anything, we use standard deviation as one of the ways that risk is measured. And it is certainly how it's measured when it comes to investing. Now, you'll have different types of formulas where you're taking excess return above the risk-free rate, and divided by standard deviation. So you're looking for risk-adjusted returns, those types of things. But, what I'm just talking about is just basic risk right here. And the question that people would want to know is the stock market riskier than it's ever been? Because, sometimes we get this, especially as we get older, we get more risk conscious, thinking about, how much risk am I taking too much risk? And what happens, it's this continuum. And sometimes what people do is they take too little risk. In other words, they take too little market risk, and that can really bite them. In some circumstances, you don't want to take any market risk at all, like short-term goals. When I'm looking at my emergency fund or I'm looking at something where I might need my money back in a short period of time, I'm going to buy a car or, whatever. It might not make any sense to take risk in that particular instance. But, when I don't take any market risk, I end up with lots of inflation risk. People look at, there was an article in the Wall Street Journal about gold, how, this wonderful long-term thing called gold that's always had demand. And I always hearken back to the thing that they did on CNBC one day where the guy's just making a comment at the end of a segment. Joe is making a comment saying, hey, you know what, guys, check this out. The return of gold after inflation over, and he's going back thousands of years. He's going back to, the Roman Empire is going back actually, he's even going back before that. And he's making a point, ancient Greece, and he says, the rate of return is about the inflation rate. So no return. You can buy the same amount of goods today as you could buy back all the way in that period of time. And, you'd say, well, it doesn't have any risk. And I'm like, oh, yeah. You look at when we had the highest inflation rates in the 1980s, what did gold do? It went down. So you think this because you hear the ads. And again, what's that? It's emotional. I can trust them. And it's like, when we were younger, a lot of you may remember, if you heard it in the media, you heard it on the TV, you heard it on the radio, you read it in a newspaper, it was truth. You could trust that what you were reading was accurate. And maybe that was part of our culture growing up. If you look at editors, and they were a lot more strict back then, I'll just tell you, than they are today. My mother was in media, and you had a strictness. You had to go through a vetting process to make sure that the information was accurate for the most part. Not always, but it was a lot more accurate. I'm just, from my experience, a whole lot more accurate back then than you have now. You have just a lot of junk out there right now. But anyway, the idea of risk, is it riskier in the stock market now? And that was something that Morningstar actually tackled in an article. They said, has the stock market has it really been more volatile than usual this year? So they're talking about, this one person was a chief strategist. I always get a kick out of chief strategists for investment firms. What are they doing? Typically, they're trying to predict the future. They're market timers, stock pickers, trying to predict the future. And I love what some of the academics I've studied under had to say. They said, I'd like to compare them to astrologers, but I hate to give astrologers a bad name. And that's quite often what happens is they get really bad results. But, people don't hold their feet to the fire, because the ones that do well are lauded. And they're given all kinds of accolades for being great and nailing it and getting the prediction right. And we forget about the ones that don't get it right. They just kind of go by the wayside. And that's part of our bias as humans. We tend to focus on things that are right in front of us. More about that in a little bit. So has it been more volatile? Well, they actually took a look at stock market volatility, and they measured it using standard deviation, as I talked about here. And they said expressed standard deviation, because of course of the war is what we're talking about, right? There, we're looking at it. Would it be more volatile with all the garbage going on? Expressed in standard deviation of daily returns, or how much the index fluctuations vary from their average, volatility for 2026 through April 10 registered at 15 on an annualized basis. Now, basically what that means is this, is if I look at an investment with an expected return of 10, if the standard deviation is 15, that means 68% of my returns in a given year are going to fall between 10 plus 15, so 25, and 10 minus 15, negative 5%, 68% of the time. 95% of the time it's going to fall between 10 plus or minus 30, which is 2 times 15. So we look at that and say, okay, so that's the volatility. Is that unusual? And it says, how does that level of volatility compare historically for U.S. stocks? And what would it take for 2026 to be a volatile year by this measurement? The answer is this. It turns out about 15% is about right for the average U.S. stock market volatility they found in the study. They said that over the past 100 years, so they used a lot of data in this little study, the average annual standard deviation of daily U.S. stock market returns comes in at 14.92. According to it's basically the PALI, which is the CRSP U.S. Total Stock Market Live Industry or History, that starts they look back at the CRSP, which is a Center for Research and Securities Prices at the University of Chicago. And they went back to 1926, and they found that was about right. So you look at that and you say, is the market more volatile? Actually, no, we really don't see that. Now, speaking of the market, the other thing I was thinking about talking about here was in regards to indexing and index funds and the problems that I've talked about. And I had this thought earlier today, and I thought, I had to just do a little look on this and see what, when we talk about investing in stock markets, one of the things we talk about is with index funds. And index funds are going to be funds that actually try to mimic or mirror the stock market in their respective area. So if I have an S&P 500 index, that's going to look at the 500 biggest companies, and it's going to invest in those companies in general and try to mirror that particular market index. So, and the thing is that with index funds, you're overweighting big companies in them. So if you look at an index fund, you buy an index fund mirroring the S&P 500, when you put money in that index fund, most of your money is really going to go to the biggest companies. At one point, it was like 40% of the index was just 10 companies. And you just go, wow. You're not very diversified when you think about it in that particular way. And the reason being is that you have some companies that are so big. Now, for example, if you have a company that is, let's say that is, 10%, or I'll just use 10% of the index, even though there isn't a company that's at that number. But just to give you an example, if I have a company that's so big that it literally is 10% of the index, when I put money in that fund, that index fund, 10% of my money, $1 out of every 10 goes to that one stock. And, that is the problem you have. And usually the example I give with people just to help them understand it is if I have an index fund with two stocks in it, one's a $3 billion company and one is a $1 billion company. And if I put $4 in that index fund, they're going to put $3 in the $3 billion company. They're going to put $1 in the $1 billion company. And I often point out, which one would you have more expected return? Well, it would be the $1 billion because it has more room to grow. Now, does that mean that would necessarily happen? No, sometimes big companies grow faster than small. That's why we diversify. That's why we own both. In fact, there's a really good video on my site my son put together in conjunction with me. We were putting it together as why aren't we tripping over Wall Street millionaires? And you can go to paulwinkler.com and you can certainly watch that. It's right on the front page. Why aren't we tripping over them? Why don't we have more people out there that are doing really, really well and have done really well in the stock market? Historically, the stock market, the returns, have been much better than most people realize, but they don't realize it. Why? Because they don't even know. They don't study it. They don't look at it. They get most of their information about investing from people selling investments or marketing investments or mutual fund companies or their workplace retirement plans, which is put together by who? Investment companies. So a lot of times, some people don't have any objective information on this stuff. So we did a whole video on it on the website, paulwinkler.com. Again, why aren't we tripping over Wall Street millionaires? But anyway, back to this whole thing about the index fund, and you're overweighting big companies in there. And this is something I refer to in that video as well. But you're putting more money there. And why? Well, it's because when you manage a portfolio that way, it's cheaper. And what a lot of people are driven toward when they invest is low visible fees on the portfolio. And don't get me wrong, it is important to keep expenses low in the investing process. Don't pay for anything you don't need to be paying for. But the reality of it is that is an emotional decision. You're being driven by emotion, and maybe that emotion is to get one over on the man or whatever. There are mutual fund companies that really play on that. They have mutual funds and ETFs, exchange traded funds that are free. They don't have any management fees. And you go, what are they? Are they running a charity? No, they're playing on your emotion. They're making money other ways in that investing process, but it's just not part of the management fee that they have to show you. And this is how people get pulled in. So what I did is I said, well, what if we took the S&P 500 and looked at the return? Yeah, return was decent last year. It wasn't by far the highest returning market segment. Last year, international small value stocks went up 52%. But, the S&P had a reasonable rate of return, just over 17% return. And you go, okay, so how about some of the holdings in that particular portfolio? What is some areas, some of the smaller companies? Now, you think of companies like NVIDIA and Microsoft and Apple, and those are the big ones. Those companies that I just named are going to drive most of the performance of the S&P 500. Because most of your money goes into those stocks. So NVIDIA is going to be a big one and those big tech companies there. But what about some other companies? What do some of the smaller companies do? SanDisk, 577% return. Western Digital, 282% return. Micron, 239% return. And Seagate, and you go, well, isn't this interesting? And you got these various holdings inside the S&P 500. Some of the smaller companies had much higher returns than the big companies, but because the index weights based on capitalization, it doesn't go up as much. Now, it doesn't go down as much if those companies go down as well. So it's a balancing act, but recognize that capitalization weighting can be a problem because it overweights those big companies. But here's the real issue with it, is it can create more risk in the portfolio when you have capitalization. So in indexing, it doesn't work as well, especially when we're dealing with smaller companies, value companies. So in our practice, in our financial firm, we don't use indexes in most asset classes. I believe in the idea of not stock picking, not market timing like index funds do. But you can recognize that there can be problems when it comes to portfolio design and engineering, in that by being very lazy, quite frankly, and weighting based on capitalization can cost money over time.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. Yeah, so something that's near and dear to my heart. There was something when I was on TV this week, I was talking a little bit about this, how younger people under the age of 18 are able to actually day trade stocks without their parents even knowing. There was an article in the Wall Street Journal about that, and talked a little bit about that. And I says, it's like, wow, these, younger people that don't know anything really about investing, other than you have these big investment firms that are making investing into a gambling experience. You walk into a casino, I said, and you hear buzzers, bells, and whistles and all that kind of thing, and people get excited about that, and you get the dopamine starts to kick in, and they'll actually have the slot machines that have a slightly higher percentage of winning, or odds of winning, will be located more near the entrances. And you go, well, why? Well, because that is where more people are going to see the winner, and then they're going to be enticed to go and play. Now, the reality of it is most people end up losing, and it's kind of like Steve Wynn of Wynn Las Vegas basically said, I don't care if you play. I don't care if you win. He said, I just care that you play. It's just the idea, as long as I can get you to engage, I know we'll win. The house will win over time, but I just got to get you to play. And that is so much what we see in the investing industry. The investing industry is going to try to entice you to do this because they know in the end they win. And one of the things that we find, and it doesn't matter whether you make money or whether you lose money, they make money on the transactions. You have bid offer spread. You may have an account that has zero commissions. And you go, how do they win it? I got zero commissions. And what you don't recognize, you have bid offer spread costs. Every time you buy a stock, you buy it from a market maker who has bought it from somebody else, marked it up, and sold it to you. So this is something that is really easy. It's a great way for them to make money because they have money on either side of the transaction. They buy it for less, they sell it for more. Pretty simple. So Evan had made the point. He says, oh, did you see the new rule? And I said, no. He says, oh, you ought to talk about it on the radio this week.
I said, what was it? He told me. And oh my goodness. So I did a look for this rule. It says SEC reverses day trading rule in a boon for retail brokers. Now, you notice that the headline says that the Securities and Exchange Commission reverses day trading rule. It wasn't as a boon for investors. You just notice that? I mean, it's kind of like it wasn't a boon for investors really helping them. It was a boon for retail brokers. And on the front of this is from Forbes, it has this, picture of this guy from Robinhood. Big smile on his face. And just say, hey, yeah, whoopee, this is really great. On Tuesday, regulators approved a change that will get rid of the so-called pattern day trader rule, a 2-decade-old requirement. 2 decades, think about what was going on 2 decades ago. Any of you remember what was going on 2 decades ago? If you said tech bubble, you win. I remember getting invited on a regular basis to investment clubs to speak. People would be, hey, Paul, can you come speak at our investment club? And I was like, you really want me to ruin your investment club? Because that's exactly what I'm going to do, is I'm going to ruin your investment club. I'm going to tell you that what you're doing makes no sense. And they would have me come in anyway. I guess they were gluttons for punishment. But that was it. So in effect, what was happening back in those days, I remember the commercials. I remember the commercials for one of the big trading firms. They had a guy, his character was named Stuart. And Stuart's boss, this is a funny one. Stuart's boss would go, Stuart, get in here. And, Stuart would come running to the office. And, you'd think that Stuart was about to get, because Stuart was out there he was photocopying his face in the office. And you're thinking, oh man, Stuart's in trouble with the boss. And then what would happen? It says, Stuart, get in there, close the door. And Stuart would close the door and he said, what do you need, boss? Hey, I need some help on this. Because Stuart's boss was going to trade stocks. And he says, let's light some candles. And they start lighting candles, for mood and all of this stuff. And they were glorifying the idea that the boss was wanting to gamble. And I will never forget one of the commercials. They said, hey, boss, which stock do you want to buy? Stuart asked that question. You know what stock that Stuart's boss wanted to buy? He wanted to buy Kmart. What happened a couple years later? Kmart went bankrupt. I think that that commercial ought to be front and center for everybody thinking about day trading. That was the poster child commercial for the day trading movement. Now what's basically happening is the rule came out in the early 2000s. Regulators worried that small investors were taking excessive risks by buying and selling stocks with borrowed money. Under the old rule, anyone who made 4 or 5 day trades in 5 business days was labeled a pattern day trader. They didn't label them gamblers, but whatever. Once that happened, the trader had to keep at least $25,000 in the account at all times. So they're basically arguing the minutia here that, the $25,000 is kind of a silly amount to have. And I look at it and go, do we have the government tell people they can't do this kind of thing? We look at that and say, well, forever, the only place you could go to gamble, there are only a couple of places you used to be able to go to gamble. You used to be able to go to Vegas, or you could go to Atlantic City, but you had to go someplace. It had to be, physically pick up your toys and go to that place. And then you hear this stuff on TV all the time and radio all the time. If you got a gambling problem, call, and they'll have a phone number for gamblers. But the reality of it is, it's a tough problem. And now it's getting into a stock market in your town, and the investing firms, the retail firms, are playing off of people's emotions to gamble by having buzzers, bells, and whistles, and all kinds of things. When you buy a stock, you got confetti that flies all over the place. And I don't know, it just doesn't seem like it's a really great thing for people to be able to do this kind of activity. It's a free country. I guess you can do whatever you want. My job is to warn you about how bad investors have done historically. Professional investment managers fail to match market returns in well over typically 9 out of 10 times. 9 out of 10 times in 15-year periods. The ones that beat, people think, oh, they're really skilled. And no, you'd have that many people would do it by luck. But when you're dealing with individual stocks, now you've taken it to a whole new level. That's even worse. The studies have been awful regarding individual stocks and trying to trade those things and trying to beat market returns, I always tell people the best thing that can ever happen to you is for you to lose the first time you ever try to do this, because that will wake you up that is not something you ought to be doing. The worst thing that can ever happen to you is you hit it big and you get lucky. And because then all of a sudden you think that you got the golden gift, and that's a problem.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.